Hello everyone, welcome to Demand Supply Trading Practical Session number 35 for the year 2025. Myself, Srijit Kakkar, and today is Sunday 14th of September 2025. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you with content related to demand supply trading methodology. Plus, whenever these sessions are scheduled, we also update on this channel so that you know well in advance when these live sessions are happening so that you don't miss on them. So in case you have still not joined this Telegram channel and you wish to join it, there are a few different ways you can do it. The first one is you can scan the QR code which is on your screen. Next, if you go into the description of this video, you'll be able to find the direct link. You can use that direct link to join the channel. And thirdly, when you visit our website, which is srijitkakkar.com, or you can use the short URL, which is sk.coach. So whenever you are on our website, you can just scroll down on any of the pages to the footer section. And here also you'll see the option which is join Telegram channel and the join now button. So these are a few different ways how you can be part of our Telegram channel. Now, getting back to today's session is a practical application of demand supply methodology. So our demand supply course is now available as a 100% free course. How can you access the course? We'll talk about it as we move forward in the session. But once you go through the course, you basically learn the methodology theoretically, that what is demand supply, how the zones have to be identified, how they have to be qualified. So everything is covered theoretically. But what happens is, unless and until we look into some practical examples, at times we don't get a very good understanding of how it has to be applied or how trades have to be planned using the process. So that is what we do in these practical sessions. So almost every other weekend, I do a practical session where we take some live examples. And the best part about these sessions is that we are not analyzing something which has already happened, because like I always say, that's a piece of cake. A move which has already happened, it's very easy to justify it by using a number of indicators or oscillators. But when I do the analysis during these sessions, we are always planning well in advance, right? We are identifying where are the areas of demand and supply, where prices might reach sometime in the future, and that is the time those trades will get triggered. So again, the analysis is not something which has already happened. The analysis is about from where the prices can turn, and those are the areas we call as our areas of demand and supply. So again, we are always planning in advance, and that is what these sessions are all about, to help you understand how you people can also do exactly the same thing. And just because we are planning in advance does not mean that I share these examples with you and then we forget about it. Whatever examples I share with you, whenever they get triggered in the future, we also review them. So what happens is, because we are planning in advance and later when they get triggered, we are also reviewing them. It helps you see both the before as well as after. And that helps you build confidence in the methodology, because nothing can be more transparent than planning in advance and later the prices coming into those areas. So that is how I conduct these sessions. We always plan in advance, and that is again the reason why demand supply methodology is also called as set and forget methodology, because you can always pre-plan your trades, you know your exits, and you just simply have to wait for the prices to come into your zones and then participate. All right, now to be comfortable with these sessions, there are also some prerequisites, and completing these prerequisites will ensure that these sessions are very light on you and you don't get confused. So what are these prerequisites and how you can complete them? So the very first one is our Trading Essentials course, optional for people who already have a very good trading background. They have been trading for a number of years. Though I will recommend, doesn't matter what your trading background has been, do start with Trading Essentials course. But if you are a fresher, then definitely Trading Essentials is a must. But if you have a lot of experience, you want to skip Trading Essentials, that can be done. But how do you access the Trading Essentials course? Very simple. Once you're on our website under services, you will be able to find the option which is courses. Click on it. And here you can see the very first one is the Trading Essentials. Click on Trading Essentials. The course is available in 2 languages, English and Hindi. So whatever language you're comfortable with, click on that button. No signups required, no registration required. As soon as you click on it, it will immediately take you to the playlist, and you have access to the playlist of all the lessons. They are lined up for you in a very systematic way. Lesson 1, lesson 2, lesson 3. Go through all the lessons, and that basically covers your Trading Essentials course. Now, Once you're done with the Trading Essentials course, the next step is your demand supply trading course, which will teach you the demand supply methodology. Now, how do you access it? Same steps under services, go to courses, and you can see the second one is demand supply trading course. Click on it. This is also available in 2 languages, English and Hindi. So whatever language you're comfortable with, click on that. Again, no signups, no registrations required. You get immediate access to the course content, go through all the lessons, and that will cover the demand supply course theoretically. Now, once you are done with the course, like I already was talking about that, just going through the theory at times, you don't get the clarity how to apply it, which is where the practical sessions are a must. So I do these practical sessions almost every other weekend. Very rarely we miss on it, but almost every other weekend I do these practical sessions where we apply whatever you learn theoretically to some real life examples, and that helps you understand how to practically plan trades. Now, what I also do is that all these practical sessions that I'm taking, we also keep an archive of the recordings. So this is where you can access the archives of the previous sessions. So if you click on practical sessions, you will have the practical sessions again in English and Hindi. Currently, the archive is getting closer to almost 2 years of recording. So you have a lot of content available to you. And like I always say, the more number of practical sessions you will see, the better you will have, you'll start having understanding of how to apply the methodology. And again, in one single session, anyhow, we can't cover all the aspects. So do watch a number of sessions, because every other session we have something new to learn from. And I also try to pick examples for every other session which are unique. See, what happens is when you're learning something theoretically, everything is a textbook example. But when you get into real life situations, everything might not be a textbook example, right? So that is why the more number of sessions you will see, the better you'll start having the understanding of how to apply this methodology. And the best part is, like I said, I do these practical sessions almost every other weekend, and these sessions are live sessions. So in case you have any challenges, you have any questions, queries related to demand supply methodology, you can always join these live sessions and you can put your questions in the chat box. At the end of the session, I do take your questions, queries, I answer them. So in a way, you are covered completely from theory to practical sessions to even whatever your challenges are. I answer those challenges during these live sessions. All right, so that's your first two prerequisites. Now, the next two is your rulebook and the flowchart. So during the practical sessions, you will see that I use two documents. One is the rulebook, the other one is the flowchart, and they help us plan trades very mechanically and rule-based. Now, how do you access these documents? Again, same steps under services. This time go to downloads, and you will see that in downloads, you have your rulebook, you have your flowchart. So this is your rulebook. Again, minded, this rulebook is a conservative approach, because when you're learning something new, definitely makes sense to start conservatively. But as you start having more and more experience, if you want to make some modifications to it based on your experience, based on your personality style, those modifications can definitely be done. And this is your flowchart, which basically tells you what you need to do as a demand and supply trader step by step. So again, during today's session, you will see how to use these documents very mechanically, rule-based, to plan your trades. Now, before we start with today's example, we do have some examples which were getting carried forward from the previous sessions. So we'll review them, and after reviewing them, we'll start with our analysis for today. So the very first one is... all right, so the very first one is from session number 25. We did the analysis on 23rd of June. Prices came into the zone on the 28th of July. You can see we have been a little deeper into the zone multiple number of times, but now we did get the opportunity to make it as a break-even trade. Now, because what we do is at 1:1, we make our trades as break-even trades, and you can see during the week prices again came down, and we would have been out of the trade as a break-even trade. So we will be closing this now as a break-even trade, because we only got the opportunity to make it break-even. Though you can see the chart was showing us that the target could be somewhere around maybe 1.5, 1.6. But even if your target was a little lower, a probability is there that you might have missed your target. So the max, the good thing could have happened with this particular trade would have been that it would have been ended up as a break-even trade. So that takes care of the very first one, which was getting carried forward for us. Just give me a second. Let me bring up the next one. So the next one is from session number 20. So just give me a minute. All right. So this is from session number 20. and we did the analysis on the 18th of May. Prices came into the zone on the 30th of July. Again, like I said, the beauty of these sessions is that we are always pre-planning our trades. So if you go back and watch the session, which was session number 20, you will see at that particular point of time, the chart will be something like this. And you can see eventually prices came into the zone. We got our opportunity to make it as a break-even trade, and it would have not been a break-even exit. Prices have continued moving upside, and you can see by now we are almost at 3:1. In fact, even if you were looking for a target which was a tested zone, you can see the zone has already been tested. So the chart was showing us that even if you're going for a tested zone, you could have a target which is close to 4:1. But again, if you just wanted to trail onto it, yes, that could have been done, but otherwise we have already got a move which is almost about 4:1 move, and definitely it also made sense. In fact, I also talked about that we had a gap zone somewhere around here. No, we didn't have a gap zone, we had a zone here. So this was basically a drop based rally. So in fact, let me just verify that. I don't think we had a gap zone here. Sorry, I don't want tested. I don't want all structures. Gap zone. Yeah, we didn't have a gap zone. This was a drop based rally. So yes, even if you were looking for an area which was already tested for the target, because I think we were getting closer to some monthly supply. You can see we are already in the monthly supply. Yes, it would have made sense to book some maybe partial profits, or maybe if you wanted to exit fully, you still had a target which was about 2:1, which would be for a tested area. So now what we'll do is, again, we'll close this trade setup, because you can see we have already got a move wherein even if you were looking to extract as much as possible, since you're already in the monthly supply, the max you could have expected was maybe somewhere around close to 4:1. But otherwise, if you wanted to be conservative, you could have still got a 2:1 on this. So we'll also be closing this, which was from session number 20. So that takes care of the first two examples. We also have a few more to review. Give me a second. Let me bring up the next one. This is from session number 22. So this one is from session number 22. We did the analysis on the 1st of June. Prices came into the zone on the 31st of July. Here also you can see we got a move which was almost 1:1, a little more than 1:1. Then the prices came back into the zone. So it would have again ended up, let me just check, where did we get the fill? The fill was on the 31st of July. Right, somewhere around here, right? So this would have again ended up as a break-even trade, but you can see we have been in the zone once, we have been in the zone twice. In fact, when you entered the zone, this is where you would have your fresh area of supply, which would have given you maybe around 1.5. So we'll also be closing this, because this is where you could have got your target. But yes, if you were trailing for some bigger targets, just by making it as a break-even trade, when it again came back into the zone, it would have ended up as a break-even trade for us. But again, the beauty here, you can see that with the analysis was done in advance, and how beautifully the zone held, right? We came into the zone, we got one bounce, we came into the zone, we got a second bounce. Yes, prices can come back, prices can move, but at least you can see that there is a methodology where trades can be pre-planned, and if they work in your favor, your reward to risk ratios can be really, really nice. And yes, even a small bounce can give you the opportunity to make them as break-even trades as well. So that's your next example, which we will be closing now. And let's move on to the last one, which is from session number 32. Just give me a second. So this one is from session number 32. We looked into it last time as well, and I think here I talked about that we had a formation of zones, so it would have made more sense to exit, because after the entry we had a formation of a zone. But I also talked about if you wanted to wait for it to have a break-even exit, that could have also been done. Now this is already tested, and you can see the prices have already started exiting. So here you would have seen that by maybe a few paise or maybe few rupees, the stop loss would have not been hit. We are still in the trade. Yes, it would have given you the opportunity to make it as a break-even exit, or maybe with a small little profit. But if I look at the monthly, we were at a good location on the monthly. I think we had the weekly support here. Yes. So since we had the weekly support, if you still wanted to hold on to it for better reward to risk ratio, that can definitely be done. And the only reason here is because it is a coinciding level, which also makes it as a weekly level. And because of this weekly zone, if you're looking for an opposing zone, we do have a 2:1. So yes, if you want to trail it for this 2:1, definitely makes sense. Can be done. And I think we did discuss it the previous or the session before it, that we had the weekly support, because of which if you don't want to exit, you still want to hold on to it, that can be done for a 2:1 target. So what I can say is that yes, if you still wanted to participate, we still have to wait for it to move above and give us a break-even opportunity. And once it gives you the break-even opportunity, then you can keep trailing onto it for a 2:1 based on the intermediate time frame. All right, so that takes care of some of these examples. Now, the previous three, I'll be closing them. This we can still continue reviewing, because like I said, from the intermediate time frame, you could have had a better reward to risk ratio on this, and it is a coinciding level. So that is where we can look for at least a 2:1 on this one. So this is the only one which we will carry forward. And the last few examples, we will be closing all of them. Because some of them, yes, definitely gave us break even. Some of them gave us the opportunity to maybe get some profits on those particular setups. All right, so that helps you see the beauty of demand supply trading methodology. And you also saw that all these examples that I share with you, they're always pre-planned, and nothing can be more transparent than this, that we are always pre-planning these areas, and eventually prices, they come into those zones, and how the prices, they react from those areas. All right, so let's get started with today's session. So whenever it comes to trading, I always say that trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based? The reason for that is that if you don't have rules, you will be making your trading decision based on emotions, and trading based on emotions definitely does not help. Now, there is a video which is called as How to Start Trading. I'm pretty sure the link is in the description. Otherwise, you can just search on my YouTube channel and you will be able to find that video. Very, very important video. Watch that video, understand the process I've explained in that video, and that will also help you understand why you need to be very mechanical and rule based when it comes to planning trades. So since we need to be mechanical and rule based, what we need to do is we need to create something which is called as a trade plan. Now, when we start learning a new methodology, or when we start learning trading, it's not very easy to create a trade plan from day one. And that is where these two documents come in handy for you. One is called as the trade plan steps. The other one is called as the rule book. And by using these two documents, we will learn how to plan trades very mechanically and rule based. And like I already said, the rule book is a conservative approach. With time, with experience, if you want to make some modifications to it to make it better suit with your personality style, those modifications can definitely be done. So what is my step number one when I start planning a trade? Step one is I need to define my trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit here, the exit can be your target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So the question comes that why do we start with our trade purpose as our very first step? And the reason we are doing this is because when we do our analysis, the charts that we use, they are time-based charts, and we have n number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these n number of time frames, what time frame should I be using for my analysis, right? That's the very first challenge. And now if your analysis is based on multiple time frame analysis, you don't have to select one, you might have to select multiple time frames, which makes your challenge multiple times. So to overcome this, we again go with a very logical approach, and that logical approach is that the longer I want to be in the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, by definition, I say daily income is a trade which can last for a day or few days. But when you are trading markets which are not 24-hour markets, so let's take example of the NSE India. Now this is not a 24-hour market, and I'm pretty sure those of you who trade these markets, you would have experienced that whenever the market opens, some symbols they gap up and some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight in a market, which is not a 24 hours market, we do have that gap risk involved, and there is no way that can be avoided. So this is why my recommendation to all of you is that initially, when you start trading, your hourlies and dailies should be done strictly as intraday trade, which means by the end of the day, irrespective whether you're in profit, loss, or break even, close your positions. Don't keep those positions as overnight positions and take that unnecessary overnight gap risk. Now, when it comes to weekly, monthlies, anyhow, we are not anticipating to get the exit the same day. Here we know we will have to wait for a few weeks or few months. Therefore, these trades will be kept as overnight trades, but that does not mean that for weekly, monthlies, we cannot have gap against us. It can still happen, but because you're leaning against some bigger time frames, the probability definitely reduces. But as you start having more and more experience, you start building up confidence in your analysis. If you want to include daily income into overnight trades, that can be done, but initially my recommendation would be to avoid it. Initially, hourly, daily is intraday, weekly, monthly is overnight. Eventually, you want to include daily incomes into overnight. That can be done. So my step one is I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I have selected my purpose of trade, what will happen is from the rule book, I'll get to know what time frames I should be using. So if I go to my rule book, and we'll go to page number 28. That is where we start with the topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame. In demand supply, we use multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2, type 3 entries, or in case we need to apply some additional rules, that is also where the refining time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames, and you get the answer from this table. Now, minded, the table which is on page number 31 is specifically for the NSE market, because this market is only open for 6 hours and 15 minutes. But if you are trading markets which are open for longer durations, like your commodities, forex, cryptocurrencies, some international markets, then you can look into the table which is on page number 32. But for NSE, because I'll be taking examples from NSE, I'll be referring to this table. So I opted that I want to plan monthly income trades. And from this table now, I know that as a monthly income trader, my time frames will be monthly, weekly, daily, 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case we need to use the refining time frame, then my refining time frame will be the 60-minute chart, which can be used for multiple purposes like fine-tuning the zone, type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number 1, now I have the clarity to what time frames I'll be using, plus what analysis I need to do on each and every time frame. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but if I take again the example of NSE, on NSE we have over 2000 companies listed. So humanly not possible that every day I sit and analyze 2000 companies. So what I need to do now is I need to have a process in place for selecting some script, so that out of this big list, I have a small list available to me. If I have a small list, I can do my analysis almost every other day. But going through such a big list every day is not an easy task. In fact, I'll say it's not humanly possible that you analyze 2000 companies every day. So how do we get that small list? For this, we use certain computer programs which are called as scanners or screeners. And the way these computer programs, they basically work is that we input certain conditions into them, that these are the conditions I'm looking for. And then those computer programs, they identify that which symbols are matching with those conditions. Whatever is matching with those conditions, it gets shortlisted for you, and that is how you get a smaller list. Now, if you do a Google search, you will be able to find a number of scanners, a number of screeners, which are based on either conventional technical analysis or fundamental analysis, and they are 100% free scanners. You'll be able to find a number of them. If you wish to use them, you can use them. But the challenge is that the more your scanner screener is in sync with the demand supply methodology, the higher is the probability you might be able to find something which is in sync with your trade plan. So how do we shortlist based on demand supply trading methodology? For this, I have created two custom built tools. One is called as the demand supply zone alerts. The other one is called as the demand supply zone screener. I'll briefly tell you what these are, but if you want to have a more in-depth understanding of it, you can visit our product pages. So if you click on them, they will take you to our product pages. Otherwise, when you are on our website, you can go to services, you have trading view indicators, and here you can see that you have the alerts and the screener. Click on subscribe now button. It will take you to the product page where the walkthrough videos are available, and those walkthrough videos will help you understand what these tools are. But I'll quickly brief you with what these tools they basically do. So if you talk about alerts, so what alerts they basically do is, can you see during the live market, I'm getting some alerts. As of now, only the crypto market is live, right? So what happens is I have applied the alerts to the 5 minutes chart. So what is going to happen is that every 5 minutes, I have given the alerts a list of symbols. Like here you can see, I've given it a list of symbols, about 20 symbols. So out of these 20 symbols, on any of the symbol, if we have a formation of a demand area or a formation of a supply area, it will immediately notify me during the live market that this is where you have your formation of demand supply zones. Now, someone who has a free trading view account, definitely you can't get alerts, but you will still be able to see those symbols as a table on your screen. So here you can see it is telling me if I go to ADA USDT, let's go to cryptos. We have a formation of a drop base rally. You can see we have a drop base rally. Now currently I have applied the indicator that I need all structures, and the reason I've done that is because I want you to show examples, because we might not have quality zone formations during the session. So just in case we don't have quality zones, at least I can show you that. Can you see we just got the alert? And similarly, if I go to the next one, which is ETH-BTC, we have a drop base rally again. Can you see as soon as the zone was formed, we have that information, and you can see the alerts are also giving me the same information. You could see here. So if you have a paid account, you can place your alerts. If you don't have a paid account, at least on the chart itself, it will keep updating you on which symbols those zones are getting formed. So that is what alerts do, that whatever list you will provide during the live market, as in when the zones are getting formed, you keep getting updated regarding them. The other one is the screener. Now, how the screener basically works is, now again, if I show you as an example, you can see in the screener, I have given a list of about 15 symbols, and then I've given my proximity setting as 2%. So what I've done is I've told the screener that these are the symbols I want to look into, but out of these 15 symbols, identify the symbols where the current candle is within 2% to a demand area or a supply area. So you can see it is telling me HDFC Bank is closer to supply, has proximity to supply, Tata Motors has proximity to both demand as well as supply, and Bajaj Finance has proximity to demand. Now, just as an example, you can see if I was doing it manually, I would have to go through all the 15 symbols manually. But now I know that these are the only 3 symbols which are either closer to demand or supply. So it saved me so much of time, where I can now avoid analyzing the rest of the 12 symbols, and I can only analyze these 3 because these 3 are closer to demand or supply zones. Now, just as an example, if I go to Tata Motors, you will see that the current candle is closer to demand, and it is also closer to supply. This will not be the supply it is telling me, because my settings are, I only want fresh zones. So here you can see I have selected fresh. Tested zones have been disabled. So similarly, if I disable the tested zones on the indicator, I'll say I don't want all zones, I don't want tested zones. So now you can see that's my demand, that's my supply. But let me bring it back. So this is what screener does. So screener is not based on what is happening during the live market. It is based on during the live market, or even when the markets are closed, if my current candle will be within that proximity range. So here what is this? So this C is telling me that the current price is outside of the zone, right? So C means it is outside. Sorry, out means it is outside. C means based on the closing. So what do we mean by the closing? Just as an example, it tells me that from the closing, if I move up 2.08%, I will be hitting the supply. So you can see from this closing, if I move up 2.08%, I'll be entering into that area of supply. Similarly, from this closing, if I go down minus 2.5%, I will be entering into this demand. So you can see this is the demand it is telling me. Perfect. So that's how the screener basically works. So now you have a brief idea, but like I said, if you want to have more information, you can always visit the product page. That is where the in-depth walkthrough videos are available. You can go through those videos to understand them better. So again, irrespective what scanner or screener you're using, always remember whatever results you get from these scanner screeners, you can never blindly buy or sell these symbols. Scanner screeners, they do not tell you what you need to buy or sell. They only help you get a smaller list. Once you have that list, you will have to analyze them manually and see whether they match with your trade plan or not. If they match with your trade plan, they can be your opportunities. If they don't match with your trade plan, you simply skip them. And this process can be as simple as maybe I just want to analyze the Nifty 50 stocks, or maybe I have my own favorite list of symbols I want to analyze. So choice is yours how you want to get that small list. But yes, there are a number of ways, out of which two are purely based on demand and supply. Now, once you have that list, what we need to do is we need to move on to the next step, which is go to the lower time frame of whatever the first symbol was, and there you need to identify zone. Now, the good news is that we have an indicator on TradingView which automatically identifies and plots these areas of demand and supply for us, and we call it as the demand supply zone indicator. And we also provide a 100% free 7 days trial of this indicator. So if you have still not taken the trial of the indicator, you can do that from our website. Now, how can you do that? Once you visit our website, under services, go to TradingView indicators. In fact, if you're visiting our website for the very first time, you will get a pop-up on the top itself that yes, you can have access to the trial. In case you have already closed it, then what you need to do is under services, go to TradingView indicators. The very first one is your demand supply zone indicator. Click on it, and you will be able to find this 7 days free trial button. Click on the 7 days free trial, and there are only a few columns you need to fill. The first one is your full name, the second one is your email address, and the last one is your TradingView username. Now this is very, very important that when you're inputting your TradingView username, make sure it is correct, because if you are providing an incorrect TradingView username, it will not get activated for you. So how do I find my TradingView username? In case you don't have a TradingView account, click here, create a new TradingView account. Once you have created your account, then you can input your TradingView username here. And in case you already have a TradingView account, you can click here to visit your TradingView profile. That is where you'll be able to identify your TradingView username, input here. Now this tells you when your trial will expire. How did you hear about us? Click on I'm not a robot and click on finish and start your free trial. Once you fill this form, within 24 hours it will get activated for you, and once it has been activated, you will get a notification on TradingView itself that you have access to the indicator now, and then you can try it for free until the date of expiry. So yes, since everyone has that opportunity, that now you can at least try the indicator for 7 days. In fact, all the examples that we reviewed and all the analysis that I do, you will see it is always based on these indicators, and that also helps you see the advantage of these indicators, that how they help you make your process very mechanical and much more easier versus if you were analyzing them manually. So yes, what we need to do is we need to go to the lower time frame. So let's assume the symbol which was shortlisted was ABC. I'll go to the lower time frame. Question is, what is my lower time frame? We got the answer from our step number 1, that as a monthly income trader, my lower time frame will be daily. So if I go to the daily chart, again I'll add, when we do the analysis for today's session, you will see that this particular example, I'll put it under the category of an aggressive trade. Why an aggressive trade? We'll talk about it at the end of the session. But yes, my next step was to identify a zone, and just give me a second. Okay, just a second. All right, so just give me a few seconds. There is one modification I quickly need to make, which I'm doing as of now. Done. Perfect. So you can see that the indicator is already identifying the zone for us. And like I said, once we do the analysis, you will see this will be an aggressive trade. We'll talk about it at the end of the session, why an aggressive trade. So my step 3 was identify a zone. Indicator is already doing for me. It is telling me we have this drop base rally structure available to us. So let's draw this drop base rally. So step number 3, which is identifying a zone, already done by the indicator. Do we have a zone available? The answer is yes, we do have a zone available. Once you have identified the zone, does not mean you blindly trade it. The next step is to qualify it, which is a 2-step process. And step 1 will qualify based on certain conditions, and in step 2 will qualify based on the booster scoring. So the very first one is that can the zone be a case of level on top of level? Now, how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be part of the intermediate time frame, which is called as a coinciding level. So if you have a coinciding level, you might have a case of level on top of level, but if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? And the answer is no. Now this is a very good example to understand why it is not a coinciding level, because you might say that, Sujit, we have a weekly zone and we also have a daily zone inside of it, so doesn't it make it as a coinciding level? The answer is no, because again, if you try to recall, what did I say? So the definition of a coinciding level for a case of level on top of level is, or even just a coinciding level is that when you have an intermediate time frame zone and the same zone divides into multiple zones, which means this zone and this zone has to be common. You can see this zone is not common with this zone, because this zone is getting created because of these 4 candles, which are my basing candles, but this basing is not common with this basing. So this is basically a test of this area due to which the zone was formed. So again, remember that the zones, they need to be common, right? The basing needs to be common. Even if it is not the basing, I've also talked about it, it might be the part of the leg out. But if a zone is made up of 3 components, which is your leg in, your basing, and your leg out, this has to be common with the zone of the intermediate time frame. So this is not a coinciding level, and since it is not a coinciding level, it cannot be a case of level on top of level. So the very first condition, level on top of level, not applicable. This zone is not because of a gap, therefore gap rules will also not apply. Talking about pivot non-authenticity, it is definitely a drop based rally structure, and to drop based rallies we always apply rules of pivot and non-authenticity. If you talk about the aggressive rule, right, the aggressive rule says that the move from the zone, right, the move from the zone should have violated at least one opposing zone on the intermediate time frame. So you can see I'm on the intermediate time frame, and on the intermediate time frame we had this drop base drop, and when we started moving up, this drop base drop was definitely violated. So you can see after the formation of the zone, when we moved up, we definitely had a violation of an intermediate time frame zone. Therefore, based on the aggressive rule, this is definitely qualified for us, right? So that's the first reason why it is an aggressive trade, because based on the aggressive rule, this is getting qualified for us. In fact, if I do a candle replay, you can see it much more clearly now, that on this particular candle the zone was formed at that point of time. Yes, we had a supply area here, and then you can see as we started moving up, this supply was violated, and that is why, based on the aggressive rule, this is definitely qualified for us. Now moving on to the next one, which is unstable equilibrium not applicable. So after applying all the applicable rules, is this qualified for us? The answer is yes, but only based on the aggressive rule. So now that we know we have a qualified area, next step is to apply the boosters. So let's go back and start applying the boosters. In fact, let me also draw this. All right, so if we start with the boosters, the very first one is freshness. Is the zone fresh? The answer is yes, freshness gets a score of 3. Strength, we do have an explosive move. That is the reason the indicator is identifying it. Otherwise, the indicator would have not identified, gets a score of 2. Time at the zone, we have 3 candles, again gets a score of 2. Reward to risk ratio, we'll take it as an assumption. Location, if you talk about the location, I go to the monthly chart, you can see we are planning our trade middle of the curve, right? So we are not high of the curve, we are middle of the curve, which is also called as the equilibrium location. This gets a score of 0. Right, if you talk about the trend, if I go to the weekly chart, you can see that we are in a sideways trend. So the trend is also not supporting us, gets a score of 0. Move from the zone, we need at least 4:1, which has already happened. You can see 1:1, 2:1, 3:1, 4:1 move, and now the prices are coming back, which again gets a score of 2. Not a case of level on top of level. If you talk about trap, if I take a horizontal line wherever my proximal is, and then we start pushing it up, trying to identify an area where the prices have been bouncing over and over again. So if I look into this area, can you see this has acted like support, acting like resistance, right? Here we have quite a few whipsaws, but again acting like support. So we do have a structure, though I'll say not a very clean one, right? But yes, somewhat there. So I will give it a score of 1 for it. And talking about coinciding level, we have already seen it's not a coinciding level. So if you talk about the overall scoring, it is a high quality setup with a score of 10, assuming we have reward to risk ratio, but low probability setup with a score of 3, which makes it as a type 2 or a type 3 trade. Now, why I also called it as an aggressive trade, we'll talk about that one as well. So now if I go to my rule book and go to action grid, so can you see the action grid basically tells us that on the lower time frame, if you have a demand zone, and that demand zone on my higher time frame is located at equilibrium location, and your trend is sideways, in a sideways we do not take any action on such a zone. So if you go with the rule book, can you see the rule book is telling us that even though we have a zone, we should not be taking any action on it. In equilibrium location, we only use a demand zone if you are in an uptrend. If it is not an uptrend, in an uptrend, if it is not an uptrend, you should not be using it in sideways, you should not be using it in a downtrend based on the intermediate time frame. So that is why I call it as an aggressive trade, because if I talk about this particular trade setup compared to the rule book that I have created for you, this trade setup does not match with my rule book. So something which is not part of your rule book, but the booster scoring is telling you that if you still want to take it, right, it is still a qualified setup for us. But as a type 2, type 3 trade, that is what we call as an aggressive trade. So again, a trade which does not qualify based on your trade plan, but the booster scoring still allows you to take that trade, that's an aggressive trade, because I know I am going beyond my rules, and that is why I said we'll call it as an aggressive trade. But again, every person has a different personality style. So for one person, the rule book that I've shared with you might be the rules you're using, but for another person, the rules might be something like this, that if I'm at equilibrium location, I just don't want to be against the trend. So in a downtrend, I will not be taking any action, but in a uptrend or in a sideways trend, I'm happy taking a long trade, right? So can you see different people, they can have different rules, but yes, following this conservative approach, this is an invalid trade for us, but as an aggressive trader, acceptable. So after applying the boosters, we got to know that this is a type 2, type 3 trade. Next is, no matter how high the quality or the probability, any trade can be a stopped out trade. So we need to be ready for the risk management by doing a proper position size calculation. When the prices are almost about to enter the zone, we have to re-verify, because the markets are not static, markets are dynamic, conditions are changing almost every other second. So before participating, we need to re-verify, does it still qualify based on my trade plan? If the answer is yes, you place your order, and once your order has been executed, the last step is your trade management, which you have been seeing for some of these examples. So what we do is at 1:1, we make them as a break-even trade. After that, if we get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically and very rule-based. And that brings us to the end of today's example, which is example number 35, I guess. Now, before we move ahead with the Q&As, I would like to add that if these sessions are helping you plan better trades, do like the video. If you're not subscribed to my channel, do subscribe to my channel. And yes, I'm pretty sure you people also understand that a lot of people are struggling with trading, and my course is 100% free. These practical sessions are 100% free. So the more you spread the word, more number of people can take advantages of these sessions. So do spread the word, help your trading community, help your fellow traders plan better trades. Learn this methodology absolutely free. And yes, that will be an advantage to, like I said, the trading community. Now, I would also like to add that yes, I do take your questions, queries at the end of the session, but there is a feedback which we got from you people, that what if I don't want to ask my questions publicly? For that also, we have an option which is called as one-to-one session. So if you want to schedule a one-to-one appointment with me on my website, top right corner, you'll get this option, which is one-to-one. There are two kind of appointments you can schedule. One is a voice call and the other one is online meeting. So in case you feel that on a voice call you can ask your questions, get the answers to them, you can go for a voice call. If you wish to share your screen, your analysis, you can go for an online meeting. But like I said, if you have any questions, queries, you can always put into the chat box during these live sessions. I try to answer all these questions at the end of the session. So ideally, one-to-one is only required when you don't want to ask your questions publicly, or maybe you want to share your screen, right? But otherwise, yes, in these sessions, you can always put your questions. So let's see what do we have in the chat box, and then we'll be ending the session. In the rule book, to understand one single line, it takes years. That much of knowledge is there in your concept. When price comes to HTF, the zone setup probability reduces. Why? So we have, okay, so let me explain to you this very quickly, because I have a Hindi session lined up for me. So see, when we are planning our trade, what we are basically doing is, this is my higher time frame HTF, let's say supply zone, which we call as very high of the curve. This is my HTF demand zone. And when we are planning our trade, so let's assume we have this zone on the LTF. So what we are ideally looking for is prices, they come back to my zone, I participate, because from here prices can move up to the higher time frame supply. Now here two things can happen. Eventually this can violate and it can continue, or from here again prices can start moving down. Now many times what happens is, price, it does not come back to our zone, it continues its move all the way to this higher time frame supply, and from there it starts coming back. So when prices are already reacting from a bigger time frame supply, what is the probability a smaller time frame demand might hold this move to the downside, right? That's a very low probability. And that is what this rule is all about, that if the prices, they don't come to your zone, it hits the very high of the curve or very low of the curve and then start coming back, the probability reduces, right? So I hope that helps you get clarity to what this rule basically implies. Even 15s time frame has the same setup, right? Liquidity script like NQ. What will be the issue in 15 seconds? Everything is the same. Absolutely. So when it comes to demand supply methodology, it is universal. Doesn't matter whether you are planning a trade on a 15 seconds chart, whether you're planning a trade on a 15 minutes chart or a monthly chart or a daily chart, the concept remains exactly the same. And as long as those symbols are liquid enough, they can definitely be traded. So like you said, the concept does not change. It's just that I personally trade only MIT trades, and those are the kind of examples I share with you. But the same concept can be applied to any style of trading. Nothing changes, right? It's just that your time frames will change, concept will remain exactly the same. All right, so fresh authentic opposing is already included curve and trend, right, as my understanding. See, again, it completely depends from trader to trader. Like I said, different trader, different personality styles. Now, if I talk about me, because I mostly plan MIT trades, for the curve analysis, I don't mind using tested areas, because I know the bigger the time frame, the more number of times those zones might get tested and the prices might still hold. But if I was planning, let's say, an HIT trade, then I will always use fresh areas of demand and supply even for my curve analysis. So again, depending upon what style of trading you're doing, your personality style, things can change. Now, someone who's very conservative might say, even for an MIT trade, I want to use only fresh areas, but now you will be missing a lot of opportunities. So you have to find the balance between how aggressive or conservative you want to be, and based on that you can decide what kind of zones you would like to use, because now you know the pros and cons of a fresh zone, you know the pros and cons of an authentic zone, you know pros and cons of everything when you're doing this methodology. So that is how you fine tune your personal trade plan, that okay, this is what I'm comfortable with, maybe I'll add this is what I'm not comfortable with, this is what I'll be removing from my trade plan. So I give you a very simple example. For MIT, I use tested. For HIT, I'll never use a tested zone for my curve analysis. Similarly, when it comes to your zone violations, for zone violations, you should always be using tested. Why? Because if a zone gets tested and next time I'm not using it for my violation, that doesn't make sense, right? So we should always be using it. But yes, somebody who wants to be, let's say, extra conservative, he might say, okay, the very first time when the prices came, it should have been violated, and that is the only time I'll be considering it, right? So that's your call. But again, for zone violations, I will always recommend that tested should be enabled. But when it comes to curve analysis, that can depend upon your personality style. That can also depend what time frames you're using for your analysis. Bigger time frames, yes, you might be comfortable with tested zones. Smaller time frames, I would say avoid tested zones for the curve analysis as well. All right, so that brings us to the end of today's session. Thank you everyone for joining in. Next, I'll be seeing you the next weekend. Till then, trade safe, enjoy your Sunday. Take care. Bye-bye.